Hello and welcome to the DIY Investing YouTube channel. We are going through every company in the S&P 500 and today is Alexandria Real Estate Equities. This is a REIT with ticker ARE. In the next 5 minutes, you will learn about how I think about the valuation on this company and what I think about the business quality. Let's dive on in. So again, as I said, this is an equity real estate investment trust, a REIT. So this is a set of real estate investments. Pretty easy to understand the business there, but let's go into see how they specialize in. So they are an S&P 500 urban office real estate. So we're focusing on urban office. This is commercial real estate. First, longest tenured and pioneer opera owner of uniquely focused on collaborative life science, technology, and ag tech campuses and AAA innovation clusters. So they've got $31 billion in market cap, 50 million square feet in assets. So this is a very big company. Key locations: Boston, San Francisco, New York City, San Diego, Seattle, Maryland, Research Triangle. So that gives us a good idea of what we're thinking about here in terms of the company. They're looking at very high quality leases and commercial real estate, urban office planning. First thing I noticed here is the beta of 0.84. That's actually lower than 1 by a decent chunk, which represents something fairly unique for an S&P 500 company. So that suggests maybe lower turnover or lower volatility. The turnover rate here is not meaningful because it's a large S&P 500 company. Now the return on invested capital looks very poor. Now we see 1 year of losses, which is 2016, but otherwise only one loss in 20 years. That's a good sign. And the return on invested capital is very stable, but it's also very low. You can see it's really stable around 2 to 3%. You get up to about 3% in the most recent years, but 2 to 3% is very stable. The stability is good. The number is not. It's going to be very hard to earn a good return on your capital with this level of return on invested capital. It's very, very low. You're unlikely immediately to have a good return. So again, when we look at 10-year median returns, return on assets 1.9%, return on equity 3.5%, return on invested capital 2%. And because of this, it's going to be very hard to get a good return on your money as an investor. But even when I look at valuation ratios, PE's at 53. This seems extremely overvalued. So unless there's something funky going on here, that's a concern. Now, what may try to justify it is you have a high revenue growth rate. And this is 14.8%, EPS growing at 8%. So the problem here and the difference between these two is they're diluting you over time. Your assets are growing heavily with revenue. That's common in a REIT, so I'm not as concerned with this company as others. Now, if we look at the gross margin, you can see the gross margins are fairly stable. 69, 69, 69, 68, 71, 71, 70, 71, 70. So the stability of gross margins is good. So they have strong ability to set their prices. They've been growing very stably over time at a strong growth rate. The earnings per share have grown from about $1 up to $3.82 in 2021 or $6 in 2020. Something weird is going on there. And like's common for REITs is they actually are required to pay out 90% of their earnings as dividends. And so their dividends are actually being paid higher than their net income. That's not uncommon because of how the accounting works. So they have $2 in dividends in 2012 to $4.48 dividends in 2021. And so they've about doubled their dividends over time. However, they have to be diluting to pull this off because the return on assets don't allow this growth. And that's exactly what we see. You basically have a company running a form of kind of like a legal Ponzi scheme because what they're doing is they can't afford to pay dividends. They can't afford to grow without diluting. So they're having to use share increases in order to grow. So they're issuing shares to grow. And so they've gone from 62 million shares outstanding to 147 million shares outstanding. So they've more than 2.5x'd their shares outstanding in that time frame. Now they've been able to 5x net income by going 2.5x on shares outstanding, which is why their EPS has tripled. So they're getting a return here, but it's very risky. It's not a good way to grow. It's not a sustainable growth rate. If they weren't able to issue shares, if the share price were to tank, then the return on this investment would be very bad. So it's not a sustainable company. If you have to grow by issuing shares, that's not good. The thing is if you look on return on invested capital, and so you say your return on invested capital is 3%, that means you can only grow 3% a year without issuing shares or issuing debt. And so if you want to grow faster than that, you have to issue shares and issue debt. And so you're being diluted and you're creating debt in order to do that. Now, debt's common on a REIT, so that's not a problem. The problem is issuing the shares. And so without a higher return on invested capital, you can't achieve a target rate of return as an investor of 10% or 12% or 15% without dilution and without massive use of debt. And so this is probably because of the markets they're in. We said they were, in very expensive markets like Boston, San Francisco, New York City, San Diego, so California. But this income statement tells the whole story. This is very risky. They cannot grow without issuing shares. So if this share valuation collapsed and went to like a PE of 10 or 15, the entire growth story would collapse as well, because they would need those shares at a high price in order to issue them without absolutely destroying the shareholder base. So I would avoid this company. It's a common problem with real estate investment trusts. You're going to see this in a lot of REITs, but there are some out there that can be good. But this one in particular is a really bad setup for having sustainable profits that aren't kind of pyramid scheme-ish. If they don't have new investors to sell shares to, they will stop growing because they cannot justify it based upon their returns on invested capital. Thank you for listening to this. Don't forget to like this video if you found it useful. Hit that subscribe button and ring the bell so you can get notifications when my new videos come out. Thank you for listening, and until next time, stop paying fees, start building wealth.